This is the longest bear market rally we have ever seen in history, if it's a bear market, but a lot of those people are in the bull camp now. In fact, if you look at how many bulls out there, you've convinced even institutions to go on the long side. We're talking hedge funds to go on the long side. They covered their shorts, they've moved out on the long side. My thing is this a bull market starting, or is this part of the psychology of the market chart? If we take a look at the psychology of the market, look at the vertical move from disbelief, which you could make a case was during COVID, right? COVID was disbelief, that huge dump, and the vertical move up in the markets to euphoria, the pullback, and then this move up. Are we in this move up? And again, to be honest, no one knows for sure.
Thursday's Consumer Price Index report likely will show that the pace of price increases is easing, but not enough to get the Federal Reserve to retreat on its inflation fight. If the Wall Street consensus as gauged by Dow Jones is correct, the closely watched Consumer Price Index will show a monthly increase of 0.2% for July and a 12-month rate of just 3.3%. The latter number pales in comparison to the 8.5% annual rate that the CPI registered a year ago, a reading that was just off the highest level in more than 40 years. Excluding food and energy, the monthly estimate also is 0.2%, though the 12-month rate is being put at 4.8%. If that all sounds like at least marginally good news, it is. Multiple data points have indicated that inflationary pressures have eased considerably from their 2022 levels. But history has shown that inflation is stubborn and can last longer than expected once it becomes elevated and entrenched. And the current round is still making an impact on consumers, evidenced by the CPI's nearly 19% rise since bottoming in April 2020 during the early days of the COVID pandemic. In this video, macro investor Gareth Soloway shares his take on various economic data, from inflation, loan demand, non-farm payroll, and debt ceiling. He also talks about the Moody downgrade and its impact on the regional banks and Bitcoin. Let us now get into the video. Always remember to show your support by hitting the like button, subscribe, and drop your comments below.
I do want to show you this one because, again, there's been a lot of talk how early on over the last couple years, inflation, and I even said this, inflation was low in Asia. All right, China wasn't seeing the same sort of inflation we were seeing over here, because over here we eat generally a different diet than those in Asia. What we can see here, folks, is rice in Asia soars to highest levels since 2008. So again, you're starting to see this big move up now into 2023 of rice, which again is an inflationary signal. And what that's going to do is it's going to put more pressure on the Chinese government, more pressure on Japan to be careful and maybe not control that yield curve quite as much. And again, that is something that has to be looked at as a concerning factor. The other thing I want to bring to your attention here as well is this is business demand for bank loans, US versus Europe. To be honest, I don't really care the fact that it's US versus Europe. They're just two separate lines. You have Europe being the light blue, the dark blue being the US. My purpose of showing this to you guys is this. If we look at demand for bank loans, it has fallen off a cliff, okay? And if we look at that and we go back to 2008, we're approaching the same levels as loans demand in 2008, right? So that does have to raise your attention. You have to say, wait a minute, what does that mean? And the reason why this is important is if you look at what causes economic growth, it's money in the system. It's people taking out loans and using that to start businesses and create revenue streams, which then create taxes, which then create more jobs and jobs and jobs and jobs and things like that. And speaking of jobs, the last thing I'll say on this before we get into some chart action is if you looked at the latest jobs report, the non-farm payrolls report that came out, I think it was last Friday or so, what we saw was a gain of 187,000. But if you looked at the underbelly, and this is the big thing, folks, is like, you know, you can put lipstick on a pig, but it's still a pig. And my point here is that if you looked at the underbelly of that economic data that came out, the non-farm payrolls report, you would see that government jobs were a huge gain, but most other sectors, most private sectors were down. They cut jobs. And so again, you could argue that with the US getting this unlimited budget, right, the debt ceiling was raised to unlimited levels, they're now able to spend lots of money, which again goes into the idea of Bidenomics and, you know, just saying, hey, we got to win this election next year. Let's spend, 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 spend. And that's the overall lipstick, right? That's the overall lipstick that we're seeing. But in the underbelly of the economy, in the private sector, things are changing. And again, this is something that raises my alarm bells.
China's imports and exports fell much faster than expected in July as weaker demand threatens recovery prospects in the world's second-largest economy, heightening pressure for authorities to release fresh stimulus to steady growth. The grim trade numbers reinforce expectations that economic activity could slow further in the third quarter, with construction, manufacturing, and services activity, foreign direct investment, and industrial profits all weakening. The pace of export decline was the fastest since the onset of the pandemic in early 2020, and the tumble in imports was the biggest since January this year, when COVID infections shut shops and factories. Gareth Soloway explored and made an analysis based on the chart from the TEMI yield, China import and export crisis, Moody downgrade, and also he talks about Bitcoin and his forecast on Bitcoin price. Let us now get back into the video.
This is the 10-year. I want to just do a quick update on the 10-year. We have pulled back off of the highs. Now, interestingly enough, the pullback coinciding with the export and import news from China we got a couple days ago. And again, even Moody's saying, hey, listen, we might have to downgrade the big banks, right? So they downgraded a lot of the regional banks, but Moody's said, we're not going to downgrade the big banks, but they're on watch for a potential downgrade. And what that does is it tells us that even though you would think maybe yields would spike, but especially with the China news, it means that the global economy is weaker, which potentially has a pullback coming in yields because the Fed may have to lower sooner than thought, right? There could be a credit crisis. There could be multiple things that force that yield to the downside. Now, today we're basically flat on the yield. There's not a whole lot going on. Let's take a look at the dollar real quick. The Dixie, the dollar, again, a lot of people don't look into this, but the dollar is really, really important. And again, if we zoom out here on this chart, I'll show you guys the level that I've been showing. I mean, I've been talking about this level for a long, long time here. And again, if we just put a trend line in here, we can clearly see that we've kind of come up here and we've retraced to that scene of the crime, right? So if we look at this, we have a clear trend line here. Here, we broke it. Now we've retraced. Right now, notice how the dollar's having a lot of a struggle or a lot of trouble getting back above that level. So if I zoom in, look at how many times it's hit the level and it's still not pushing through. That's because that is major resistance, what we would call a major technical trend line. Now, if it's able to stay here over time, it might be able to push up, which would be honestly a very big negative probably for risk assets, and likely, and this is what we saw, if you look at this move up here, which coincided with that data point from from China, the export-import numbers, anytime there's fear, anytime there's chance of a global crisis, people are still going to run into the US dollar. The US dollar, even with de-dollarization starting and the BRICS countries talking about gold and let's back our currencies by gold, the dollar is still king dollar. That's the essence of it. Now, Bitcoin had a decent day yesterday, and the reason why it had a decent day, and this is your 10-minute chart, by the way, which you can see popping up a little bit, the reason why it had a decent day is because of Moody's. So Moody's, again, downgraded banks yesterday, and basically threatened to downgrade some of the bigger banks. And what we could see is as soon as that downgrade came out, Bitcoin started to pop up. And the reason this happened is the same reason why over here, this is where the bank crisis, where Silicon Valley Bank failed and these other big banks, these other medium regional banks failed, Bitcoin soared, okay? So what we're seeing here is a clear divergence. When you have the stock market selling because of economic woes or anything like that, Bitcoin still is a risk asset that goes down. When you see Bitcoin will go up when we see credit issues. When there's issues in the banks, money flows from the banks into Bitcoin. That is a tremendously positive thing for Bitcoin in the longer term. Now, short term, again, I still think if we hit a recession and we start to see the stock market down 20%, assuming it's not a credit crisis, then I still think Bitcoin goes lower. But if it's a credit crisis, I actually think Bitcoin could end up breaking higher. So watch to see which angle this goes, credit crisis or just regular run-of-your-mill recession, or maybe both. We'll have to see again how that plays out. But right now, again, you could argue that, again, maybe this is a little bit of a bullish tint to it. This is your trend line to watch. And again, I got to put it a little bit more accurately. I really try to be as accurate as I can on these trend lines. Should be really touching that little low. But basically, this trend line is around 27,700 to 800. If it breaks this, I would be concerned with Bitcoin. as long as it holds above this blue line, I actually think Bitcoin's okay here. I don't have a problem with Bitcoin.
Former Fed Governor Richard Clarida isn't so sure the Fed should end its current rate hiking cycle, which began in March 2022 and has seen 11 increases worth 5.25 percentage points. Now the global economic advisor for asset management giant PIMCO, Clarida said his former colleagues need to send the message that they're continuing the inflation fight. They'll want to keep their options open. In particular, they don't want to declare mission accomplished too soon, he said Wednesday during an interview on CNBC's Squawk on the Street. But they also can't be tone deaf. They need to acknowledge the data is improving. At the macro level, the Fed rate hikes have appeared to do minimal damage. After declining in the first 2 quarters of 2022, GDP hasn't been negative since and is tracking at a 4.1% annualized growth rate in the third quarter, according to the Atlanta Fed. Americans, though, remain largely dissatisfied with the state of the economy and have punished President Joe Biden with an anemic approval rating of just 39% in the latest CNBC All-America Economic Survey in July. That's because damage from the elevated inflation levels and the rate hikes are often felt more in the microeconomy, such as small businesses and household debt levels. A lot of people rely on both credit card and home equity lending to make it all happen, and they're launching a small business, and credit card interest rates have been increasing slightly faster than Fed funds, the central bank's key interest rate, said Patrick Raleigh, co-founder of Uplink, a global credit assessment platform for small business lending. Banks have been tightening credit criteria as well. Raleigh said the rate hikes and loan default rates for small businesses generally rise in tandem, causing a credit crunch that could persist. On the bright side, if the data continue to cooperate, the Fed at least can take its foot off a monetary policy break. Regional Presidents John Williams of New York and Patrick Harker of Philadelphia both made comments this week indicating they are entertaining putting an end to the rate increases. What do you think would be the outcome, bullish or bearish? Let us know in the comment section below. Also, don't forget to like, subscribe, and turn on notifications. Thanks for watching.